Let's see. And play.
Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither philstockworld.com, CSW, nor its affiliates, nor any of the respective offices. Personnel, representatives, agents, or independent contractors are in such capacity as licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. CSW provides education and training services that are meant to teach you to the risks and potential rewards of trading options, and we are not the service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on a specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any loss you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone.
All right. Let's see what's going. You may want to put a note on the feed that it's starting. Oh, yeah, I usually do that, don't I? Well, you'd hope people know this, but I will. Okay, and if that's true, if I might put out here, line of the meeting. Speaking of meetings, I got to get out of here. Not a long webinar today because I must run to my own meeting. I rescheduled this and it screwed me up. Okay, now we get to go. Thanks, Brian. Good idea. So where are we? First of all, take a quick look at the markets. I'm mostly concerned with oil at the moment. I have three new short. I got out of the old. I'm up $1,500 basically for the day. I just started getting back in. My average is 49.15, and we're at 49.19. I wouldn't want to really add another one unless I could get 15 cents higher. So that would be 20, 25, 30. So at 4.30, if I add another one, it brings my average up to 49.20. So that's kind of worth doing. But unless we get that high, I wouldn't really want to add another one. So then I have to consider, well, if it's a 49.30, should I be stopping out or adding more? And I kind of lean towards adding more. I think this is kind of bullshit. So first things first, we should take a look at whether or not the, if the oil inventories look like something that should be shorted. So let's take a look at that. So we're going to look at the petroleum status report. And we just got the 1 o'clock release, so we'll see what it looks like. I don't usually read the text. I want to see if they have anything to say here about the storm. No, they don't. It's just all facts. They don't really talk about like what's actually happening. Basically, there weren't any major changes. You see the difference? See, the exports got kind of jammed up. Our exports dropped. And that, of course, led to a build because we were sending out 300,000 less barrels a day, basically. So about 2 million less barrels went outbound for the week. That's mostly product. That would be gasoline and stuff. So that would explain the lower than expected demand in gasoline. Overall, the product supplies, very, very little difference. Only 500,000 less product supply per day. So that's 3.5 million shortage. So the storm didn't really have any kind of impact here. But look at the one thing it had an impact on, though. They immediately jacked the prices up, which is what we thought was going to happen. But last year, on 9/5, it was 223. Now it's 269. That's up, what, 20%, a 20% jump. And oil's up too. Oil took a nasty jump. Last week it was $2.39. So we got a big 15% pop in a week on the price of gas. That was very, very nasty going into the holiday. I did see some stations with like $3 a gallon, but generally they're like $2.75 around me. In fact, there it says $2.67. That's just really gouging. I mean, that's crazy. And especially when you consider that actual gasoline, the futures, are like $1.67. So they're marking this thing up $1. And I want you to think about this. There's a markup of $1 over the retail price of gas, right? The retail price of gas versus the gasoline futures. So, if we look at RB on the futures, and the dollar long too. If we look at RB on the futures, 165. So at the pump, they're charging $2.65. It's $1 more. Now, consider that dollar gap, because when gasoline is $2 a gallon or $1.50 a gallon, it's not like you're buying the futures are 50 cents. When the futures are $1, that's when your gasoline's like $1.50. So these guys are gouging you so much that as the price of gasoline goes up, they're also expanding their margin at the same time. So it's a huge markup. And people who benefit from that are people like, Sunoco is a good pure play on that. Valero is making money on the refining side and the gasoline side, so we'll take a look at those guys. But Sunoco just has gas stations. They don't do refining anymore. And you can kind of see how they're picking back up. They're actually probably a good pickup at this price. I like Sunoco anyway. So, Sunoco, we were championing Sunoco down here because it's way stupidly cheap. But even now, it's still a pretty good price at $32. And Valero, they're up in their channel now too. So they're more toppy. But Sunoco can do very well off of this kind of price spreading, because what's going on? Sunoco is buying gas for $1.65 at the wholesale prices, and they're retailing it to you for $2.65, making $1 per gallon. So imagine every car that pulls up to a Sunoco station is giving them $15-20 profit. Boom, boom, boom. How many retail places in the world will make that kind of money? So they're going to have a very, very, very good quarter this quarter. And I don't think that's in any way baked into the prices. Let's see what else is going on. All right, sorry. So trading-wise, where are we at in the futures? So there's nothing special about the oil report, so therefore I'm happy with my shorts. That's what I wanted to check. And so I am shorting right about this price at $49.15. So right where we are now, I've got the oil short. Now, I'm prepared to see this thing go to 50 and add more shares on the way up and bring my average up to like $49.50 on the way up. And I'll have a pretty big loss, because at $49.50, let's say at 50, I'll have 8 contracts. Okay, so that's where my conviction goes to, 50. And let's say I have 8 short contracts. I would be down 50 cents on those 8 short contracts. Even if I bring my average up, I'll still be down 50 cents by the time we get here, and that's going to be $4,000. So just to be very clear, that's what I'm willing to risk on this trade, is willing to lose $4,000. But I feel very strongly that this is a top, and over the next 2 weeks, we're going to see it, especially as we move towards the contract rollover period, because there's still a lot of open bullshit contracts that are going to have an issue. And what's my website that I can never remember? It's futures.trading charts. Okay. F-U-T, yeah, this. And then I can never remember what the light crude oil quote. There it is. How nice. Okay. So it's not horrible. There's 453,000 open contracts. Sometimes they're like 650,000. But what's bad for them is the rolling cycle, because they generally roll out to the next month and next month and next month. The problem is, though, that you've already got 200,000 contracts in January. That's very unusual. Usually, and March is jamming up too with 135. Usually the front month out is going to be like this, 54,000 or something like that, not 135, not 195. And if you add these up, you got 750, 850, 950. Wow, wait a minute. Yes, 750 plus 3 is 1050, 1080 right there, plus another 2. That's a sick amount of open oil. It's 1.25 billion open contracts. I mean, that's crazy. They just, it's not that much oil. We talk about this all the time. It's not going to be delivered. It's all bullshit. So these contracts all have to be unwound. So, I mean, this is a ridiculous situation. And because December is already so jammed up with contracts, and and January is jammed up with contracts already, when they try to roll these contracts out, they're going to flood November, and they're going to flood December, and they're going to flood January with ridiculous numbers of open contracts. And it's going to cause a bigger and bigger problem. It'll be a big problem this month, and an even bigger problem next month. So, I'm looking for at some point, this contract expires 25th minus 3 working days. So 1, 2, 3. So maybe the 20th is going to be the last day. That's only 1, 2, 7, 8, 9, 10. 10 working days. So 450,000 contracts in 10 working days to get rid of them, 45,000 a day. That's already a lot of pressure per day. And they're going to have to move all these contracts into these months. So we are going to see probably a good amount of pressure. So that's my logic in a strong desire to pursue the oil trade. All right, but nonetheless, there are rules. So I have to, unfortunately, if we cross back over 49.50, and I'm going to have to go back to 2 contracts, because when you add a contract, you're adding it to, when you start adding contracts, you're adding the contract to raise the, in this case, raise the basis. But there's no point in raising the basis if you're not going to stop out of the extra contracts and get back to your original amount. So I'm really looking to trade 2 contracts at this level. I would love to trade more at a higher level, but if we're only at this level, I'm not going to, if we start going back up, I'd rather have 2 contracts and wait and see what happens. Now, the dollar we talked about this morning at 91.40, I pretty much called the bottom. Now, it's kind of funny, though, because I have to be careful because I say, it's like, I caught the bottom. I didn't necessarily I didn't necessarily catch the bottom. I may have caused the bottom by writing about it. You have to realize that when I write about something, there's so many people reading it that it's possible that when I said I like the dollar at 91.40, that caused all this buying at 91.40. Because be very careful about that. And then it goes up in a big spike, and then it comes down, and then people start buying again when it gets down, and now it's going back up. So we have to be careful to say, was I right about the dollar, or is this just people buying because I said that I thought that was the bottom for the dollar? Because these highs, if we're getting lower highs here, it might be good to just take this little money and get it off the table. So this doesn't mean I'm right. It's a tricky thing because I have to be very careful because if I say something like that, I may have actually caused this to happen. So that doesn't mean my theory was right. It just means that a lot of people believe my theory was right. And in the broader sense, that doesn't make it right. So let's see. And the Russell is testing 1,400 again. And how are the other indexes looking? Let's see. Everybody's showing a little bit of signs of life right now. The NASDAQ's the most enthusiastic. I don't know if there's any particular news that causes. Oh, we were going to see what Mester had to say, right? Mester was going to make a statement from the Fed. Mester. Okay, so she's being hawkish. She wants rates to get raised. Nesta said that would be a mistake to hold off on raising rates. It's not market moving because she's a hawk being hawkish. And we'll see what happens. So that's one. We have 3 more Fed speakers tonight, so we'll see what happens on the way in. But she is prepping now. She's always hawkish, so it doesn't mean anything. But if the other 3 guys all line up behind her and say, yeah, it's a good idea to raise rates, then you've got something going. Because then maybe the Fed is preparing us for their September 20th meeting. They want people to have the expectation in line that they are looking to raise rates. And that would be significant. That would be definitely, obviously, bearish for the market because they really don't want to see rates going up right now. And again, that was my premise for being long the dollar, though, is I do think the Fed is going to, it's not so much that they have to even signal that they're tightening, it's just that for some reason people think the Fed is going to I don't know what they think. They think the Fed's never going to raise rates, so they're going to lower it. I think in the very least you're going to get indications from the Fed that they are still expecting to raise rates. And if that's the case, then why is the dollar so weak? And if we look at the chart there for the dollar over the longer term, yeah. I mean, look what's been going on since the summer. The dollar from 97 to 92, that's 5% or more than 5%. The euro from 112 to 120 is 8 into 112 is, I don't know, some other number, but 6% or something like that. That's a little much for the dollar. So, and not even the Canadians. Look at the Canadians. They've gone up 10%. So, I mean, these are some big moves in currencies, mostly caused by just the perception of dollar weakness. Now, part of this is a lack of faith in the U.S. economy, in the U.S. government especially. We have the debt ceiling thing coming up, and that would, of course, be a crisis for the dollar. But that's, they're already going to extend that, so I don't see why we're going down. I mean, in the very least, that can is being kicked down the road, and we're certainly no looser in our monetary policy than Europe is. And England is another Goldman Sachs toady that runs the Bank of England, so, Carney. So he's not going to raise rates. Japan, they're insane. They're not going to raise rates. So not many of these guys are going to have looser policies than we do. So why are we down 5-10% against them? So that's it. That's my premise. My premise is that the dollar should be more in the middle of maybe 95-ish. So as I said this morning, I think a 3-point gain is in line, at least a 1.5-point gain to 93.50. That's not too much to ask. So we'll see. But it depends on the euro. It depends. Now, I think this line at 120, I don't think they really want the euro to be any stronger than that. So, we'll see what actions are taken. No questions. Fantastic. All right, I'll just keep rambling on then. It says, quiet day. I don't know where everybody is today. People are worried about the hurricane. My brother just, my mother and my brother are both down in Boca. And my mom was kind of going to ride out the storm because she has a lot of friends down there and she doesn't want to leave and whatever. Because I was telling her yesterday, I said, just take a flight out and come, stay somewhere else. But she didn't. So now my brother's grabbing her, and they decided, looking at this picture, which I just said to my brother, made him change his mind, that they're going to get out of Dodge. I just sent this to my brother, and he was like, "Okay, we'll go." Visual aids. Here, this. That is the storm surge warning. This is a storm surge watch. So this is a storm surge area for Florida. And there's Boca Raton. Here's Boca Raton right there. That's underwater. So this whole area, and there's Delray beaches down here. My brother's office is down there. Not good. It's very, very, very ugly. And it's just widespread. They're going to have, it's not just that there's going to be water, because they don't live on the beach, so they should be okay. But it's that the electrical lines will go down, the sewage will be in the streets, the fresh water supplies might be gone. Why go through that? So they're going to go to Orlando. They said right now, though, the roads are already bumper to bumper with people heading out. I told them to go this way, to head in the middle and go up from the middle. Don't try to go up the coast, because everyone from the coast is bugging out. But the bumper to bumper traffic on the highways get people getting out of Florida, and this fourth storm is not even going to hit them until like Saturday night, Sunday morning. But this is going to be a complete disaster if the hurricane actually hits them here, because these places, Florida's flat as a pancake, it's barely above water, and if there's a storm surge, literally water can wash across this entire thing. Like a wave can come from here and just go right across the entire state. And that's going to be a disaster. So it'll be interesting to see how that pans out. But I'm very glad my mom's heading out, because I wasn't very comfortable about her sitting there. But so meanwhile, speaking of the hurricane, though, we got all kinds of things happening. If it hits Florida, it's not going to affect oil or gasoline, though. That's one thing people weren't understanding. And that's why I think also these prices will calm down. It does affect orange juice, and we were looking at that yesterday. There's orange juice is banging up because, that can really, as the storm moves forward in Florida, it can totally destroy all the crops. And you can end up having, 10% loss of the orange juice crop for the year, and that's not good at all. So we'll see what happens there with that. Not too much else. It's mostly natural gas won't be affected the way this is going, so that's not a great play for the upside. And gasoline's already coming down strongly. Now, interestingly, gasoline's coming down strongly. Oil's not. And the logic the oil traders are using right now is that, the refineries will come back online and then there'll be demand. But that's not real. That's just, all it does is go back to normal. Back to normal is not an increase in demand. They're so grasping for straws that they'll take anything as an excuse to bring the price of oil up. But it's not going to happen. I don't expect it. One interesting thing is somebody just posted about Comcast. These are things you don't even think about. Comcast is losing subscribers because of the storm, which is really weird. But I guess, I think to some extent, I think people, see, it's probably true of a lot of you guys. You got to realize it about yourself, though. It's like, I don't think like a poor person. So, like, if I'm not going to be in my house for a month, I don't cancel my cable bill. And then turn on a month later and save $100. It doesn't even occur to me. Like, I just went away I was away for a month in the summer. I could have easily done without several of my things. It could have saved a few $100s. It's not even something I think about, though. But they actually have it. So with all these people leaving their homes for an extended period of time in Houston or whatever, they all call the cable company and cancel their subscription. They're like, well, I'm not home. I can't watch cable, so cancel it. So they get hit with subscriber declines there. There's also this incredible competition. My daughter, Jackie, she showed me a Fire Stick, which I never really looked at using a Fire Stick. She stuck it on my TV, though. It took 2 seconds to set it up because she already had it, so it was already set up for her. It took 2 seconds to set it up. It's like Apple TV. It's the same kind of thing. It's got every show. It's got everything cable has if you're willing to pay $4 card. And it's fast, though. It's not like Hulu or Netflix, because it's its own dedicated device. And Amazon does not do a good job explaining this to people. It's not like watching Hulu or Netflix because it's fast like Apple TV is. Like everything is like a computer. It's like click, 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 and things pop up. And I didn't realize they could do that in that little USB stick, but they can. So the dedicated device has a better processor than your TV does, and it allows them to it allows you to just go bit and get shows and search for things and find stuff really fast. And that's what I was impressed with. Not also everything is in high definition. You tell you on HD on everything. Everything's in HD. That's a big problem for these guys, for these cable companies, because there's really not much logic. If you look at how much money you spend on your cable bill, it really doesn't make any sense. You know what I mean? Because I have the phone. I know my bundle's like $100 and something a month, and it's taxes, so it's probably like $129 by the time I'm done with it. If I wanted to, I could just get the internet service for like $49 a month, super fast internet service only, $49 a month. I would use my cell phone, which I'm using, which I have anyway, so I could be a cord cutter. And then I'm not going to pay. I don't spend more than $50 buying. I'm already an Amazon customer, and I won't spend more than $50 a month watching movies and buying TV shows. It's like most things are a couple of bucks, and there's plenty of free stuff, and there's only a few things I would pay for anyway. But it's cost effective, and I think that's really hurting them because people, again, it goes back to there are people who don't have money, which is most people, and most people are these people's customers. Not me. I'm not most people. I don't think about saving $10. Doesn't mean it's not. If it takes me time, I'm not going to go out of my way to save $10. But most people don't have that kind of choice. They'll take their time to save another 10 here, 10 here, especially when it's monthly money. That adds up tremendously. That's whether or not you have a nice Christmas. Saving two things that cost $10 a month means you have an extra $400 at the end of the year, or $250 at the end of the year, and that's a better Christmas. And you have to realize as an investor that other people have that mentality. And that's when you look at these mass market companies, you have to realize that that's what they're dealing with now, because the disposable income of people in this country is just falling apart completely. And it's a real problem. I mean, there's all these consumer-based companies that rely on selling things to people over and over again. And even Netflix, so you look at them and say, oh, well, people are switching to Netflix or whatever. But the problem with Netflix is also they've got such a penetration now, and they can't just raise prices. People are rejecting the price increases, and they've got to compete with the Amazon Fire Stick and the Hulu and the whatever. So, they've saturated the market. There's not a lot of room for domestically, there's no room for growth. Internationally, they've still got room to grow with it. But Netflix's growth in the last few years has been because they added a ton of countries. But as far as in the countries they're pretty much at saturation level. So that means the only thing they have going for them in the future is to raise prices. But they aren't going to raise prices because people aren't going to put up with it. There's too much competition. So there's a lot of businesses that you have to really think about, like, do people really have this kind of money? Tesla's another one. How many people really have money to buy base price $35,000 electric cars? And it would be fine if there was no competition, but there is competition. Now, at $3 a gallon, if the average person drives 15,000 miles a year and gets 30 miles a gallon in a normal car, they're going to use 500 gallons of gas. So it's $1,500 a year is how much they'll save with the car. So an electric car at $1,500 a year worth of gas, and ignoring the price of electricity, obviously there's the cost of electricity too, is going to save you, say, $7,500 over 5 years. That's how much less gas you'll buy. Probably half of that you'll spend back in electricity. Really not enough of a savings for a person to alter their habit and go electric. And obviously the same kind of people who buy a Prius would buy a fairly cheap electric car because they want to be good for the environment and all that. My daughter wants an electric car, not necessarily a Tesla. She just wants an electric car or a Prius. In fact, I said to her, though, I did the math for her. I said, look, a Prius is basically just as environmentally friendly as a Tesla because you're using so much less gas. But you don't have to worry about plugging it in. And she's kind of leaning towards maybe a hybrid does make sense, rather than have to sit there and worry about plugging things in all the time. Especially since it's a car she'll end up taking to college, where God knows what she doesn't even know what college she's going to. So who knows what arrangements there are for electric cars wherever she goes. And also visiting places, driving with friends, so on. It's too much to have to deal with for people. And that gets back to the overall problem of electric cars, is they're not that easy. You don't have the infrastructure in place to charge them. And if it's that difficult to find a place to charge, and then go back and think about going back to your old college right now as a freshman, and don't mean going back to your college like 20 years ago. I mean going back to your college as a freshman right now. Where do you charge your car? What do you do with your electric car? What do you do when you go on a road trip with your friends? What do you do when you go into your favorite places from college? How likely is it that you're going to have an easy time keeping your car up and running? And it doesn't take, I don't think there's too many people who want to say, well, that's no good. I can't do that. So then, boom, you've got if you're not going to capture the generation of people who are in college who are going to be the car buyers for the next 20 years, what the hell are you doing? It's not a viable product for the mass market then. It's a specialty product. It's a niche product. That's why Tesla is a ridiculous, overpriced piece of crap at this level. I'm not saying electric cars aren't cool. I'm not saying the whole world's not going to have electric cars down the road, but not soon enough to justify this valuation. That's for sure. And frankly, I was hoping they'd go higher. I wanted to start shorting them. If I had caught 370, I would have been happy, frankly. I would have started there. I was hoping for 380 so I could start shorting again. I was greedy. I shouldn't have been greedy, really. Last week, we had a little surge. It went to 358. I was hoping for better this week. It went the other way. Now it's moving up again. So I'm hoping they go up, but only so I can short them. Because this is a stupid valuation. And they're announcing their truck. That's another reason I stayed away from them. They've got a truck announcement coming up. But again, impractical. Look at my brother right now. They're evacuating out of Florida. They're going to be stuck on the highway for 8 hours on what should be a 2.5-hour trip. It'll probably take them 8 hours to get to Orlando with all the traffic. Which is no worse than me going to the Jersey Shore, frankly. That's actually important. Same thing though. It's not that unique. Okay, yeah, that's unique. He's in a hurricane, but again, what would happen if he had an electric car? How the hell would he charge it? It's hard enough getting gas. There's no way you're going to charge an electric car in between. But routinely in New Jersey on a summer weekend, you can get stuck for an hour, 2 hours in traffic in sweltering heat, where you have to run the air conditioning in your car, and you can't get off the road. You're just stuck on the highway in some kind of traffic jam. Going into New York City and commuting, same thing. You can be stuck in the Lincoln Tunnel for an hour and a half. If you have a car that can't easily be gassed up, or that takes, or that runs down on you, that's a disaster. So we're just not there yet as far as the infrastructure. I can't wait for electric cars to be the only kind of car in the world. But to do that, McDonald's has to have charging stations, and we need faster charging anyway. But you need to have like there have to be chains of restaurants that you know you can get charged at. And if Tesla was smart, that's what they would do. They should make a deal with McDonald's, because who doesn't know where 5 McDonald's are around them? So Tesla should say every McDonald's in America will have at least 4 chargers, 4 charging ports at every McDonald's in America. So if you're ever anywhere and you need to charge up your car, just find the nearest McDonald's. That would give me massive confidence in driving my car around. And that's what needs to happen. That's when you know electric cars are going to be a thing. And somebody has the balls to do that. Now, Tesla is a smaller company, and there's 11,000 McDonald's. So let's say it's not. See, that's the funny thing. It's not even that much money. Even if a charging port costs $3,000 each, which I think is what they cost for a home garage. Obviously, it'd be cheaper if they did it in bulk. But let's say it costs them $15,000 per McDonald's to install these things. 15,000 times 11 million is only $1.5 billion or so. I know it seems like a weird only, but it's only. And if Tesla doesn't do it, then GM or somebody will do it. If you're serious about your car being mass marketed, you need partners. You need to get these charging. You need places to charge everywhere. And if you're not doing that, then you're not serious about your car being mass produced. So worry less about building battery factories and worry more about finding places people can charge up the damn cars. On the hurricane, yeah. Well, if it wasn't for the floodwater just means you're definitely going to lose your power. And it's like there's almost no chance that the power plant's not going to go offline. And that's just ridiculous, because then it's not just about riding out the storm. It's about just being in miserable situations for days. And so I'm glad they're just getting away from that. I don't think, where they live on the land and where they live in the houses and the way they're built and all that, I don't think that's really the danger. I think it's more of the massive inconvenience of being cut off from civilization for a few days if they try to come back. I think we have a hard time coming back from Orlando also. Many moons ago, I bought a January 18 WPM 25 calls at $4 now they 40 cents. They've not moved up at this recent silver what. That I don't know. I don't quite know why they're not responding. I would think I think if you hold out through earnings, they're going to be good. But also, I want to tell you, I didn't get a chance to talk about this on the show. We did the show yesterday. We came into Wheaton in November at this price, down at 18 or 17. That's when it became the trade of the year. We pulled it out on Thanksgiving. In fact, yeah, it was Thanksgiving. So it was right here, right before it just took off and blasted higher. So we got a really good price on our actual trade of the year. But yesterday, and I forgot to mention, I was on TV, and when I came on BNN, we adjusted the trade for BNN. And the adjusted trade, which is here, and hopefully I can teach you this and I'll change your investing life right now. That's my goal. All right. So on January 18th, we came on BNN. I said, look, here's what you want to do. Rather than be aggressive, even though the stock had already popped up to, the stock had popped up to about 20 at that point. So even though it was at 20, I said, I don't want to do that. Let's do this. So we bought the $17 calls, which were very expensive, $6.90. But what we took advantage of was the run-up in Wheaton caused the $22 calls to be $5. So it didn't matter that these calls were $6.90. We sold calls for $5. And that's the key to this whole strategy. We also sold the puts. And because, again, it was still volatile, so we got a good price for the puts. But on the bull call spread alone, the spread only came in at 190. And we had the 17. So we were in the money at 18.90 net. What's happened since is the stock hasn't gone anywhere. It's only $21 now. It's barely budged. But we came in we're down. See, these lost $545, but the calls we sold lost more money, and that makes us up like $3,000, even though the stock hasn't moved, and even though the calls we bought lost money. And why is that? Because we weren't the suckers paying the premium. We sold naked calls to some other moron who paid premium above us. He bought $22 calls for $5. He needs $27 just to break even. He's a moron. So, what was your play? You bought the $25 calls for $4. You need $29 just to break even. That's bad. Don't ever do that, because you know why? Because this is what happens to you. Now they are 40. Okay? Oh, I can highlight that. Good. Look, now they are 40. This is why you never buy a naked call. It's a sucker's move. You're paying premium. Premium will expire. It is the only thing you know for sure in the market. 100% of the premium you pay will expire. If you always sell the premium, you will make money. You won't make necessarily all the money. You will always make some money because you always sell premium. So you bought the 2018. So anyway, so you bought out of the money calls. It's not that the stock has done badly. It's basically flat. It hasn't picked up yet. They haven't had earnings yet. When they have earnings, which will be, they're going to announce pretty good earnings as silver's coming back up. But then you just got to look at the silver prices lately. Earnings doesn't say. So I don't know when. But then if we look at silver, so here's the problem. So last quarter ended on June 30th, right? The average silver price last quarter, April, May, June. So April, May, and June, the average silver price was probably about 17 and a quarter. This quarter, don't forget, Silver Wheaton buys a strip. So they buy here, they buy $13.91 for the next couple of years, and they buy $13.62 for a couple of years, $14.61 for a couple of years, $15.83 for a couple of years. They'll keep buying. So their average is a blend of what's here. So their average price that they paid, plus they get a discount. So their average price is probably $15, $50, $16. So last quarter, they made good money. This quarter, what are they going to do? So far, the average is probably right about here, 16 and a quarter, right in the middle of these guys. So their average is probably right about 16, 15 maybe if they're lucky so far this quarter. That's not better than last quarter. So why should their stock price be better than last quarter? You understand? Like you can see whether Silver Wheaton's price should be higher or not by saying, well, how much money was silver last quarter and how much is it this quarter? And if silver's more this quarter, they're going to have better earnings. But you also then have to say, well, is it more compared to what they've been buying it for? So last year there was a big spike in the price of silver, and that's going to start hurting them if silver prices are lower than this spike. Probably 18 months to 3 years is their time frame, and you have to worry about the impact of these things. So it's not yet, but if silver stays down, they'll have at least a quarter where they got some pretty bad prices, probably 6 months, where their average price that they paid was higher than what they've got now. On the whole, they run like a 2 to 3 year blend of contracts, so you really want to look further back at the average. So their average is whatever the average of a couple of years is. So if you go back 2 years, let's say, and draw a line, I would say probably 16-ish is about the right price that they're paying. So the more silver is over 16, the more money they're going to make. Here, for a brief period of time, they took a hit, and that actually happened this quarter. So they're going to get penalized for that. Let's see, WPM. Oops. So yeah, it's really basically just what you'd expect based on the action. So there's no magic to it, and that's why we took such a conservative spread. That's why our spread is in the money. When silver wheaton was at 20, we took the 17.22 spread. We're looking for a 10% move in 2 years. You were betting, I don't know when you did it, but you're betting on a pretty big move happening in a very short period of time. It's not the same bet at all. And that's why we could make a bet like that and make money, and you could make a bet like that and lose money, because you're the sucker we sold the premium to. Don't be that person. The first thing you've always got to say is don't be the sucker. Always think about what you're doing when you're doing these things. Oh, 11/19, thanks. November? September, October, November? Okay. It's a while out. They moved to FTR from Comcast. Well, FTR is certainly fighting to get some share. What's the fair value of lumber liquidated? Ooh, haven't looked at them in a while. The fair value, I guess the fair value is where they are because I lost interest. They got a nice pop also. Yeah, certainly not making any money, are they? Let's see, quarterly. Yeah, here it comes. Okay. It's going to be a while before they really make any money. They're moving at $1 billion pace, so their revenues are up. Let's say $70 to $100 million going forward, and right now their market cap is $1 billion. So, I'd say they're fairly priced here. I don't see a great move up. They're going to have a good thing because they're going to have people replacing their floors and so on and so forth for all the hurricane damages. So they should have a good time, and they're not badly priced. We loved them down here. I was banging the table on them constantly. When they went up past 25, I lost interest because that's, you're getting into a fairish territory for them. I think 30 is when we called the end of the trade. And then it went down, and had it gone down back to here, I would have probably wanted to buy in again. But unfortunately, it's popped up since. And I would say they're at a fair price. They're certainly not overbought right now. They're basically priced where they should be for what the expectations are going forward. In fact, let's take a look at what the analysts are saying. They're saying 60 cents a share next year. So that's actually a lot. That's a pretty high PE if they're only going to earn 60 a share. I think they should be better than that. Shall we? Sharp. And what we get now is. Oh, that was coming down. Yeah, 2013, 2014, they were up about $70 million in net profit. The thing is, nobody's projecting that for next year. People are projecting 19 million, which is, I think, pretty low. I think that's not reasonable. So they're actually kind of low still, based on the fact that this kind of estimate is I think short selling by quite a lot. That's based on $19 million of forward earnings, and if you look at the quarterlies, okay, they dropped $4 million here. They're gonna, that's what somebody's projecting that out and not looking at it. But this is all damage from legal and all kinds of bullshit and discounting, trying to get their customers back. Going forward, though, they're going to get back on a growth path. So anyway, so the bottom line is that they're fairly valued now. They obviously still have headwinds and so on and so forth, but I think they're a good price. And if you wanted to get into them, Certainly, I would say sell a put because they're pretty volatile. If we look ahead at lumber liquidators. So basically the selling the put just lets me say, what would I buy them for? And so would I buy them for $30? Yes, I would. So that's free money to me. So you can sell $30 puts for $370, and what's the worst thing that can happen? You can sell the $25 puts for $250. That's even better. So you sell it. Look. So let's say I say, okay, for $25, it's $40 now. For $25, I could sell. Not for two. Oh, wait a minute. What was the last sale here? $245 was the last sale. You can certainly get $225. So let's say at $225, and I say, okay, now that's the $25 puts. I'm getting it for $22.75. So let's say I sell 20 of those. All right. So I'm going to collect $4,500. My margin is $3,300. And that's it. So it's just drop 45. In fact, frankly, in the long-term portfolio, I would add that trade because that's a perfectly good trade. Because again, it doesn't cost us anything. The long-term portfolio doesn't cost us anything. All we're doing is making a promise. Say, hey, if you ever want to sell me lumber liquidators for $22.50, we're in. Well, what is that? I'll say that about almost. There's hardly any stock I'm not going to say that. It's about 40% off the current price. So that's always, you got to look at things and say, well, okay, it got away. I didn't get a great price, but I wish I had bought it at $22.50. Well, now you can't. You can still buy it for $22.50 because you can promise to buy it for $22.50, and somebody's going to pay you $4,500 for that promise, and it ties up less margin than the cash you're going to collect. So it's free money. It's not entirely free because what you're paying your promise to it. You're pledging your promise to pick up the stock if it actually does get cheap. So you don't mess around. It's not like you can do it in a tiny portfolio, but when you've got a decent sized portfolio, it's like, why wouldn't you do? Why not? And that's kind of one of the things we do in the long term portfolio is we like to pick up $5,000 a month selling some kind of puts. We're always looking for like $4,000 and $5,000 put sales, and basically it just becomes a monthly list of companies. So in 2 years we'll have 24 companies, and then it obviously rolls over because we're only selling 2 years out. So every 2 years we'll have 24 companies about rolling over. Sometimes it's 18, sometimes it's 16, sometimes it's 32. But we'll have that many puts open of companies where we say, well, if they get really cheap, then we'll buy them. But if not, we'll get $5,000 a month from promising to buy them. So there's $60,000 a year. Even though it's $1 million portfolio, making $60,000 a year is nice. That adds 6% to my overall trading. And that's only in exchange for promising to buy some crap that I would like to buy anyway. That's a very fundamental underpinning to our strategy is doing things like that. STR preferred is yielding 48% 4 payments. Wow, that's crazy. Okay, so that's where we are in that, and let's take a look at what the markets are doing. We haven't found any good futures trades yet. Well, we did. I mean, the ones I was in. They're drifting around. There's nothing concrete here. I can't talk too long because I gotta get to a meeting, so I've only got about another 30 minutes tops. This line might be interesting to play for a bounce since the S&P is moving up, and I want to watch his pink line. So you want to watch that line. If the S&P breaks over, then the Russell should break over too. The NASDAQ seems to be moving up. The Dow is kind of iffy. Ooh, oil took a nice turn down. Gasoline is sort of laying there. Natural gas laying there. Nikkei has my dollar. My dollar's gotten flat. Gold laying around. Silver laying around. Coffee. What on earth time frame is this? Oh, No, it should be KCH8 is the one I like actually right now. That's next March. 132. All right, so we had a little dip below 49, but it came back up. And I have, oops. So I have 3 open. So what I should do, since I got a nice dip, and it went back over 40, so I should stop out and buy one back. All right, so I'm going to do that, and what that's going to do now is now I've taken more money off the table. So when we started this session, I was up $1,500. Now I'm up $1,900. So what I've done now is raise my basis, and now I've lowered the amount of open positions. I only have 2 shorts now. And if it goes down, I'll still be happy to make some money on the way down with 2 shorts. But if it goes back up, I'm also happier to double down, because now at 49.16, to get my average up to 49.20, I only have to sell one at 28. Right? Because if I sell 28, that's 8 over 49.20, and I can take the extra 8 and I can distribute it to these 2 shares, and that'll bring my average up to 49.20. So now basically I would add 1 at 49.28. That'll bring my average for 3 up to 49.20. And then if my average is 49.20 on 3, now I'm going to look for a nickel improvement. So 41.35, I would want to add another one. And that would give me 15 cents to distribute, and that would bring everybody up to 30. And you got it. That's you get more by just practicing that. You get more used to it. Basically, so it's just something where you have to get good at dividing and figuring out like how much money each thing is going to incrementally change your average. And that's all it is. When I'm scaling in and out of these positions, when I'm scaling out, there's nothing complicated here. All I'm talking about is I add one, I subtract one, I add one, I subtract one, and I do it in a laddering style. So, and my goal is primarily to raise or lower my basis. If I'm short, I want to raise my basis. If I'm long, I want to lower my basis. And I'm doing it so that I have a position I can happily sleep on. Not about making money, although obviously I'm accidentally making $2,000 along the way. It's not about making money. It's about just getting the basis high on the ones I have left, so that when I go to bed at night, I'm like, I really don't give a crap if it goes to 50. I'll happily add 2 more, because I go to sleep with 2 in a fairly good position. If you want to be a long-term investor, you've got to learn to control those entry points. Long-term future is a very scary game, but you've got to get good at the short game first. And the short game is all about improving your position every chance you get. So like in my dollar here, I have 2 long dollars. It's looking a little weak, and I'm up like $300. So if I can't hold 60, I should get out. 60 is down here. So if it can't hold 60, I should get out, take the money, and be happy. We started at 91.40, 91.60 is up 20. It's going to give me like a 250 profit or something like that, and I'm done. You got to lock in your profits. Greed is the thing that kills you. Okay, making money and then saying, "Oh, I want to hold on and make more money." That's the worst thing you can do in this game. You just got to know when something's not working. Remember what I said about the dollar? I'm worried that the only reason we have these double bottom is because I told people this was where the bottom would be. We're not getting a lot of success at the top, and these highs keep getting lower highs. So at this point, if this thing can't hold, if this line can't hold, then there's no real buyers. And that means I just need to pull back with the dollar. I'll be happy to go back in if I see another good bottom forming. But right now, I don't see the point in riding it out until I lose the $300 I made. You know, that went back. I'm just so unhappy. You know, but you've always got to be very, very skeptical of your profits. You never know if they're going to be, how long they're going to last. They can all get erased very quickly. And especially, as I said, we have like three different Fed speakers speaking after the bell today. So that's going to move the dollar around, especially drastically. So do I want it? If I've got $300 to lock up now, do I want to, into the uncertainty, have two open dollar positions when I could lose thousands? Just based on like some statement somebody makes? No, it's not worth it. Oil is different. I have a fundamental conviction to oil that I'm willing to be short even if I go down a few $1,000. But not the dollar. The dollar, if the Fed says they're going to do, they're not going to, if the Fed says we're going to wait all year until, let's say 3 guys later all say, I think we should hold rates till the end of the year. There's only like 4 or 5 guys left on the Fed at this point. Everybody's resigned. So it's going to be weird. And Trump's going to appoint people. I'm trying to figure out what Trump's agenda is for the Fed. I can't. I really don't know what he wants. He, his trade talk, his import-export talk is strong dollar talk. But his other policies are weak dollar policies. So, what does he actually want? And he's not. And also, he doesn't consider it important. He's not appointing anyone to the Fed. He's just leaving seats empty. So that's crazy, too. But, there's definitely a contingent in Washington, and especially in the Republican Party, that wants to completely disband the Fed. And maybe that's what he's doing. He might be disbanding it by attrition. His people may be forcing these people to resign one by one. And God knows what will happen if we have a central bank. That'll be really interesting. I'm not quite sure how that's going to support the dollar. So, there's a lot of ifs and thens there. It's hard to say what's going on. So on the whole, the markets are looking weaker, so there's no good long here. These are all looking fairly weak, and we're just going to have to wait and see what happens. Now, if I wanted to find a short, it would be the NASDAQ. If these guys start breaking down below their lines, the NASDAQ is the highest above his line, so he's the guy we want to short. And, of course, if the dollar is weakening, then you got to look at maybe shorting the Nikkei. Well, it's not really high. Back in 1905 would have been better short, so I'm not sure I want to jump on that one either. All right, we've got comments over here. Oops. Expect lithium prices to ramp up faster than the article suggests. Even a small shift in EV sales curve to the left, there will more lithium prices quickly at the margin. 35,000 tons was mined last year. At 7 kilograms per car is only 5 million cars. Yeah, but we're nowhere near selling 5 million cars. But of course, that's different because all lithium is used for other things. But yeah, you're right. That can be overwhelming fast. If you get to 25 million cars, where is the 5 times increase in the mining of lithium? How are we going to pull that off? This is biodiesel Chris making a very good point. Electric grid storage needs orders of magnitude more lithium than cars do. Yep, that's true. And Tesla's building this gigafactory, which not only is about making batteries for cars, but it also is making batteries for homes, and that's going to require quite a lot of lithium. Okay. Lithium, SQM, okay. Long-term hold. Here, GE is in the space, and we like GE. Definitely like GE at this place. So let's see. LIT and SQM. Let's take a look at those guys. LIT is what? Oh, it's a lithium ETF. Well, that's actually not a bad idea. Wow. See, the problem with ETF is there's no earnings per se to an ETF. They hold various companies. So you're kind of double dipping by looking at the holdings. FMC, here's SQM. So SQM, he's talking about buying SQM. They're 16% of LIT. Then you've got FMC, but then it's Samsung, you couldn't buy yourself. Tesla uses lithium, so that's sort of not the same ballpark. Panasonic uses lithium. Samsung uses lithium too. So you have a lot of guys who use lithium. And to me, if I'm going to get an ETF, I'm not sure I want an ETF. I don't like the setup because it's sort of like you're kind of betting. You're betting against yourself. The ETF is called lithium, but it's lithium and battery tech. And if the battery guys run out of lithium, that's not going to help you in general. Now, SQM, on the other hand, they're in Chile, which is too close to Venezuela for my taste, but there's crazy stuff in there. Wow. And they're just blasting higher. That's too bad. That would have been a great pick a month ago. Wow. Look at this. $50. So this is already well up in speculative territory. I wonder if they actually make money. That's pretty robust. Like $2 billion. Yeah, look at that. $2 billion in sales and $300 million in profits. They're running a nice operation. They are profitable. If anything exciting going on quarterly, they don't give you quarterly, so you don't know. So let's focus on 300 million. 300 million sales. Nothing crazy on the debt side. Okay. 300 million profit, sorry. And they want $13 billion for that. So yeah, this is accurate. So 38 PE. And I would want to know more about, how big is their mine? How can they increase production? Do they have environmental issues? Blah blah blah. There's a lot to look into at this price. If they were still in the 30s, I'd be like, oh, cute. See, what I'm talking about is people buying it. If they were still in the 30s, I'd be like, oh, that's cute. Let's jump on that. But this would definitely require a little more thought on my part before recommending it. It's just a matter of missing the bus. I'm not saying it's bad. I'm just saying that it might be that ship has sailed. They only have short-term options, and they're not great prices. I mean, you can sell. If you want to get involved, you can just sell these $40 puts for like about $1.60, $1.70, and that would put you in at 30, 38, 38.50, whatever, 38.40. If I want to dip my toe in the water, that's a good way to dip your toe in the water, and you either get the stock cheaply or you get a couple of bucks in your pocket. That I would do, and that I would say is a no-brainer, because if you can get it 20% off, then it makes sense. But I don't think I'd be too enthusiastic buying it here for $50. If you buy the 30s for 21, sell the 40s for 12, that's 9. That's not even worth it. So the only way you'd want to do a spread is if you could do like the 40-50 spread, which is 12 and 6, or 12 and 550 is 650 on a $10 spread, and then you could sell these guys for 160, and you got what else is 650? You'd be down to like $5 on a $10 spread. But the problem with that is, though, you need this price to hold, and again that goes back to I don't know enough about it to say that That's a definite thing. That $50 will hold. I don't know why it wouldn't pull back to 45 and kill your trade. I don't know why it wouldn't pull back to 40 and actually close and take a loss. So that's why it becomes not a trade I would recommend, even though I like the idea. It's just something where I'd have to get a lot more comfortable with this company and their future. I have no doubt about the lithium demand, but what I want to know is how much of a mind do these people have? How much long-term capacity do they have? What are their costs of doing it? And are there any environmental issues to expand their business or even to keep it going the way it is? Those are all things that have to be looked at to make a decision on something like that. But I do definitely agree that lithium is going to be huge. And there's no avoiding it. There's no other viable tech on the horizon that's going to substitute for lithium in the near future. Your thoughts on Amazon, please. Oh, I have so many weird thoughts on Amazon, actually. I mean, different thoughts. Wow. Up since today. I really like them much better as a short here than a long. First of all, look, 250 times earnings at getting towards $1,000 a share. So that right there puts me off. Okay. If I put it nicely, that puts me off a little bit. They're a dominant force. They're an incredible company for that purpose. But they're only making $3 billion. Okay, and go quarterly. Let's take a look. Let's add up the quarters and see how they're doing. Adding up the last quarters. 1.5. This isn't even $3 billion in the last 3 quarters. Last year they made $3 billion, but this last 4 quarters, not $3 billion. They're on a losing track as far as that goes. And meanwhile, though, you have to buy them for $470 billion. So even being generous and saying they're making $3 billion, which they're not, the PE would be 150. So they're asking for 150 times what they earn to buy the stock here. The problem is also it's a dangerous short, though. You can grow sales forever. Their sales really aren't that much. That's the funny thing about it, and that's what's dangerous about shorting them. The sales are only $135 billion. That's not a lot. Okay, Apple, $215 billion in sales. And that's only one thing. Walmart, $500 billion in sales. Target, $69 billion in sales. Costco, $118 billion. So they're as big as Costco. So it's funny, Costco makes more money than they do. But Costco is valued at $69 billion. So 1/8. It's kind of silly. So Amazon's just overvalued for what they do. This is important, though. I wish I had time to talk about this in the show yesterday. But it's a real long-term macro, but it's something we need to keep in the back of our heads. And here it is. I have in my other computer an extension on Chrome, and it's called, which I forget what it's called now. Anyway, I have some kind of shopping extension on Chrome. And what it does is whenever I'm buying something, it checks to see if I could buy it cheaper, and it also checks to see if there are any coupons. So while I'm buying it, without me doing anything, I don't even have to click on it because it's a Chrome extension. And to make a Chrome extension, you just go into Chrome here, and you say, what do you say? Tools? Extensions, yeah. Then you say extensions, and it shows you these extensions that you can get. Now, apparently this one, oh, this isn't my account. This is Jackie's account, I think. This doesn't have it. But AdBlock Pro is an extension of Chrome. So that's how easy it is. You just go, it's like an app. So this thing, when I'm in Amazon, when I look to buy something, like, like if I'm going to buy some iced tea or something like that, or what time is it? Shoot, I gotta go soon. Okay. So if I'm looking to buy some iced tea, it'll say, oh, I found this cheaper somewhere else. And like I was buying, and very obscure site, I was buying something from Sakara, which is it's a food delivery thing. They serve gourmet vegan food. I actually recommend it if anybody wants to diet. It's a really good way to go on a diet. So I'm on Sakara, which is a site hardly anybody's heard of. And as I'm checking out, it gives me a coupon for a $50 discount, about 10% off on the meals I was ordering. This is the problem that Amazon is going to have, and all retailers are going to have, is because what that is, it's a form of artificial intelligence. This thing is watching me shop, and when I'm going to buy something, it says it has the ability, because it's a artificial intelligence, to go through the entire internet while I'm clicking. In the time it takes me to make a few clicks and to put in my address or whatever I'm doing, this thing is checking the entire internet to see if there's a better way to buy what I'm buying than what I'm doing. And if it does it, it tells me, and that's what happened. A little thing popped up, and it said, I found a few coupons. Would you like me to try them? So, I'm just filling out my form, and I was just about to shop. I didn't even know it worked on that site. I didn't even know it would do anything. It comes up, and a pop-up thing says, would you like me to try some coupon codes? I'm like, yeah, sure, why not? So I press click. It runs through like a few coupons apparently, and I guess it replicated my order and kept trying to do it with different coupons. And then it goes, boom, I found one that saved you $50. Would you like to use it? I'm like, yeah. But, think about that. That's Sakara. They lost $50 that they would have made otherwise. Amazon, as this stuff catches on and people start using it, and you know what's going to make it catch on is when it gets incorporated into things like Siri and into Google and into, automatically incorporated. Like somebody like Apple's going to do this because Apple is looking out for you because you're the buyer of an Apple phone. Apple isn't selling you stuff on the web. They're selling you a phone that makes your life better. So when artificial intelligence gets to the point where it can start making sure it saves you money every time you do something, they're going to incorporate that as a feature into your phone. And the phone companies will start competing on who can save you the most money, who can get you the best tickets for concerts. Like my daughter, she likes One Direction, or they broke up with like whoever, Harry Styles. So if Harry Styles is in town, she wants tickets. Duh. So eventually her phone will be smart enough, and I mean eventually, like in a few years, her phone's going to be smart enough to say, well, I know Jackie likes Harry Styles, and tickets are going on sale in 45 seconds at Ticketmaster, so I'm going to make 10,000 attempts to get a ticket for her. And even if she doesn't say it, it'll still be like it can still try it. And while the tickets are on hold, it'll contact her and say, "Hey, Jackie, I've got an opening to get these tickets. Would you like to confirm the order?" Or maybe she can put a standing order in and say, "If I can get Harry Styles tickets in my area for less than $100, get it for me." And so it's always going to be on the lookout, constantly looking on the web, just in case her request comes in. And that's her personal little assistant sitting in her phone. And we're all going to have those. And they're going to be looking for discounts for it. So it won't be any more that you shop. And see, this is going to be a problem for Amazon because it's not going to be about going to Amazon because it's convenient. Because your phone is going to decide, or your app is going to decide to go here because including the shipping and everything else, it's going to calculate who's got the best deal on every single item you want. And so you're going to say, that app or phone will talk to your fridge, and your fridge will say, these are the things I need, and your app will order them, and so on and so forth. But the problem is, it's not, what Amazon is selling you now is this convenience of knowing you better and having the better artificial intelligence, but they do it to their own advantage, and they're not giving you the best prices. Whereas, as the artificial intelligence moves away from Amazon and down to you, it's going to kill Amazon. Because what are they? They're a middleman who's making your life more convenient. But if the middleman becomes something in the palm of your hand, and it can just as conveniently get things, do you really care if you're ordering on Amazon, if you get the thing you want for the price you want? No. All right? And you can say, well, I trust Amazon, blah, blah, blah. But look at Rotten Tomatoes. We were just talking about that today in chat. Rotten Tomatoes tells you whether a movie's good or not, and it's one of the things that's hurting the movie business is because Rotten Tomatoes, it used to be they could wide release something like Transformers, and even if it sucked, they would release it in 2,000 theaters on a Friday, and it would take until Saturday night before enough people knew that it sucked to stop going. So even a terrible movie could have a really good weekend for the first weekend. Now that doesn't work anymore because Rotten Tomatoes tells you immediately. Like the second the first guy in the first theater in America sees the film, already there's enough reviews for Rotten Tomatoes to tell you this thing's trending down. And people change their minds because they trust Rotten Tomatoes. They trust Rotten Tomatoes because it's actually pretty good at telling you what's a good movie or not. Yelp does the same thing with restaurants. It's hard to open a bad restaurant these days because Yelp will kill you right away. So that same not technology, but that same programming mentality will be applied to people who deliver stuff. So your phone will take into account not just the price, but whether or not the retailer is trustable and delivers things the way you like it, and so on and so forth. But all those things are going to be taken into account at the customer level. And then it's going to be all about price. And when it's all about price, Amazon is going to matter less and less, and their margins are going to get less and less, and it's going to be a big problem for them. It'll be, who it's going to be good for? It'll be good for the people who manufacture stuff. Because all the middlemen is going to gradually get completely cut out, and you're going to basically start ordering, because the factories are going to get smarter too. And so you'll end up ordering directly from the factory. So when you need something, you're going to order it from the producer of the thing. And all the middlemen in the world are going to get themselves cut out of these processes. But as to Amazon, the problem is they're so far away. 150 times earnings is so far away from 20 times earnings where you want a sustainable company to be, that they don't have enough time to get there before this stuff, what I'm talking about, overtakes it, which will be about 3 to 5 years, 5 years at the most. WikiBuy, thank you. Yeah. So WikiBuy, I super recommend, by the way. It's called an extension on Chrome. It's an app on other things, I guess. It is great. Yes, the carrot. Look, it's pricey food. It's vegan, but I eat it like once a month. I go for a week, or once or twice a month. I go for a week of it, and I'm telling you, I feel great. And it's like a cleanse. It's like almost a body cleanse. It's like all healthy crap for a week that I eat. No bad stuff. It's doing a very good job of kickstarting the diet for me. So for me, it's worth it. I know it's ridiculously expensive, but it gives me a discipline because of the way they deliver everything. Like it's got literally lunch every day, breakfast, lunch, and dinner every day. Is I open up a thing and I eat it and that's that. No thinking, no changing, no cooking. That's good for me. So I'm using it. It's yes, it is a ridiculously expensive way to lose weight, but fortunately I can afford it. But I really seriously recommend it though if somebody has trouble sticking to a diet. It's really good. So what else? Amazon, we talked about it. What if Amazon growth succeeds, but the government wants to break them up because it's too dominant? That too, but it doesn't even matter. They're temporarily. They have a temporary advantage because they've got the artificial intelligence. Because right now, artificial intelligence is held by a few corporations. But as it moves down to your level, and again, the reason it can move down to your level is because there are other corporations like Apple who benefit, who serve the consumer. And I'm not saying Apple is saints. I'm just saying their business model is to give you the greatest phone you could possibly have. And that's going to mean giving you digital assistants that are better than anything else in the world, which means as good or better than what Amazon can provide to their own people. And it's a war. And that's what you see going on, like with Airbnb and stuff like that. That's what all these disruptive technologies are about. That's what Uber's about. Taxis are inefficient compared to Uber. So Uber is destroying the taxi business. Airbnb is actually more efficient than hotels. If you could better trust the places on Airbnb, and again, it's the same thing. You need a Rotten Tomatoes kind of thing for Airbnb. But if you could better trust the providers of services for Airbnb versus a hotel, and if Airbnb got it together, their providers got it together and learned to give you certain amenities that hotels give you, it would probably kill the hotel market. But as it is, hotels, because of the internet, the reliability of the internet, and the check-in desk, and the convenience factor, and the know nothing's going to go wrong, or if something does go wrong, they'll most likely fix it. There's a lot of things for business travelers, especially, they can't put up with Airbnb. Just in case, if there's ever a problem, you can't have a whole, business trip ruined because Airbnb screwed up. You can't. That's not an excuse. So that's holding Airbnb back. But again, they'll get it together too, probably, because it's more efficient than hotels. There's all this empty space in houses and empty houses around the country, and that's cheaper to run than a hotel is to run. But they've got to get it together with other stuff. They can't just, the way most people run it is not enough service. But it's the same thing with Uber. Uber is more efficient than a cab. Even the cab companies that are trying to adopt better services, the bottom line is that I use Uber. When I went to Europe, I used Uber in Paris, I used Uber in London, I used Uber to go to the airport, I used Uber in New York City. It's the same freaking account everywhere in the world. I just push a button and do it. I don't care. It's done to my credit card. I don't exchange any cash. I just get in the car and I go where I have to go. The language. Oh, that was also great in France because the language barriers. When you don't know the language, but you don't have to talk to the cab driver or explain anything to him. Just you put in the location and he goes to the location. And not only that though, but in Italy, because the cab driver's there, sometimes they'll go like way out of the route and charge you extra. They can't do that anymore because Uber tells you the route, and you can see if you're deviating from the route. So it tells you the best route to go from one place to another, and the cab follows the route, and you get out and you're done. No currency conversion, and also how many times you get to an airport you don't have the local currency as a pain in the ass. So again, and with Uber you just don't need it. You just get in the car and go. It's unbelievably convenient. And that's what's killing all these cab companies, and it's very difficult for them to recover from that. It's all over the world convenience. All that stuff is moving into the hands of the consumer, and that's going to be the worst thing for retail. Especially middleman retail, and Amazon is the king of the middleman retail. Their whole thing, all they're doing is they are conveniently creating a system where you know that you can, where you have merchandise and you know it's going to get shipped to you and you know they stand behind it. But as that power moves into your hands, what are you going to need Amazon for? And especially if they end up being more expensive. So it's going to be very, very difficult for them long term to grow themselves the way people think they will. All right, I got to go. Unfortunately, I have a meeting, so I got to run out of here. I don't know anything about the WikiBuy. I guess WikiBuy is the name of the company. I don't know if it's a company per se. I think that's one of those things that's just like mindlessly convenient. I don't think they're even looking to make money on what they do. Which is crazy, but because frankly, I would certainly pay for it. It routinely saves me. I'd say routinely saves me 10% on things when I buy stuff. Easily, sometimes 20, 30%. It is crazy. Like batteries. I was buying batteries, and I was like, well, you need to buy these batteries here instead and save 30-something%. I was like, wow, really? I felt like an idiot. I'm like about to buy the batteries, and it's telling me how stupid I am. That's the future. But that future is very disruptive for specifically people like Amazon. Travel companies, too. The travel companies are going to have problems. Travelocity and so on and so forth. And again, it's going to be that Some things are more complicated. It'll be a while before all the hotels and so on and so forth, because the individual hotel sites suck. If you go to a lot of small hotels are terrible at letting you look at their site. I don't know how long it'll be before a travel assistant that lives in your phone will be able to do what Priceline does, because Priceline and Expedia and Travelocity, they have people who shoehorn all that data from all these different hotels into a standard format that makes it easy for you to look at and decide what you want to do. You know, like when I'm looking, Travelocity is my, I have everybody's got their go-to. I like Travelocity, and the reason I like Travelocity is because it shows me, I can check off, like, I definitely want a pool, and I know they all do that, but I like the way it works. I can just filter for a pool, I can filter for different, I can say late checkout, so on and so forth, and I can, and it shows me, I can list them in order of price, I can list them in order of stars, and that on the ratings, and I know that if I click on something, though, it's always going to show me the hotel with some pictures and a room, and I know you're saying, yeah, mine does that too. It's just I'm used to the way it works, and I like the way it works. I end up using Travelocity most of the time. The point is, I don't know how long it'll take a digital assistant to be able to do all that for me. To be able to take, it can go and check all these hotel sites, but is it going to be able to do all those things for me in a standard way that lets me look at it and feel good about the choice I'm making? So, there's some things that are easy to do and some things aren't. But on Amazon, though, see, that's the problem. Amazon's not doing anything special. I want an item, and I want it as cheaply as possible, to be shipped to me as cheaply as possible, as quickly as possible. And it's not necessarily true that Amazon is the best place to go for that item. But given the fact that Amazon's competition is 10,000 other retailers I'd have to check, I'm going to use Amazon because it's convenient. But when my phone is able to check 10,000 retailers and tell me Amazon ranks 14th as far as value, and here's 14 guys who are better than them, that's going to kill them. And that's the problem in that kind of business. So, Phil, can you look at QQQ and see why it keeps going up? I don't know why. It keeps going up because Apple keeps going up. There's a lot of good stocks in the QQQ, and people are still buying the leaders. Should we even be in those hedges that are killing us? Well, if the market collapses, QQQ is going to totally collapse. If people start questioning the value of these things, they're going to collapse. It's a hedge. If you're in QQQ to make money, get out. QQQ is a hedge against things collapsing. So I don't think the Nasdaq should be over 10,000. Not 10,006. That's not the Nasdaq comp. What the hell is the symbol for the NDX? So I don't think the NDX should be over 6,000, which is right where we are. And I think there should be a pullback. And we've had a run from 5,000 to 6,000. We did have a pullback. In fact, we had a classic on a 1,000-point run. We had a 400-point pullback, pretty much on the money. That is a strong retrace. Then we came back up. Now we had a weak retrace, and now we're back up. So actually, this is actually bullish. Per the 5% rule, this is actually pretty bullish because that's what it's supposed to do. You have a strong retrace, then you have a weak retrace. You're consolidating or move higher. But I don't think the valuations justify it. So I say to myself, well, okay, so now let's see, from 4,000, did we ever get the real consolidation? So we go from 4,000 to 6,000, and we've never gotten that pullback. Here we have a weak retrace here. So what I'm thinking is more likely is that the 4,000 to 6,000 run here got one weak retrace, and the next retrace we're going to get is a strong one. So a strong retrace there is going to be 800 points down to 5,200. That is, I think, a fair price for the NASDAQ. It's coming back around there. So I'm looking at some point this year to come all the way back down to 5,200. And it's going to seem horrific, but it's still very bullish. It's still very bullish. We move from 4,000, you go to 6,000, you test 5,200, and then you can move on. So that's what I think. I don't think this will last. All right, and that's it's based on partially on 5% rule. It's bullish within the year on the 5% rule. But since I don't believe in this valuation, I'm looking further back and saying, you know what, I think this is what the problem is. We haven't had the proper consolidation off of this whole run, off the 2-year run. And I think that's where we're going to run into trouble. So we'll see. All right, but people are still buying it and whatever. But that's what I'm saying, though. If it collapses, we'll get a big pullback in the NASDAQ, and that's when your insurance kicks in. But it's insurance. So if you're in it because you want to win on the Qs and you're not winning on the longs, that makes no sense. Like in the short-term portfolio, where is that thing? In the short-term portfolio where we have the hedges, well, we're not even losing money. We're still up 411%. The SQQs are down 18, 24, 25, minus 2, 23. So this is down $23,000 in its current iteration. Okay? But that's fine. And then we have the TZAs, and TZAs are down 25. So down $50,000 on our hedges. All right? Fortunately, we made some money on labor. That's offsetting it a bit. But the long-term portfolio is at 214%, but it's a much bigger portfolio. It's up at 1.2 million. So that's jumped another $100,000 in like a month on our long positions. So, you know, and again, we didn't lose $50,000 a month in the long-term portfolio. I don't have time. Well, here you go. The two combined portfolios as of 8/20, which was only 3 weeks ago, was 1.96. Okay, so yeah, 1.96. So what are we at now? We're definitely higher than that now. It's not about like whether you're winning or losing one position. You've got to look at the combined portfolios. So we're at 1.2 here. Wait, what number did I say? 196. Oh, I'm sorry. That's not 196. It's 2 million. It's 1.2 in cash. 1 point. So that makes more sense. So we're 157. So it's 157 plus short term. 511. So what do we say? 157 plus 511? Wow, it's huge. 157 plus 511. No. 1570 plus 511. 223. Get out of here. 511 690. How'd that happen? $157. Jesus Christ. So 2238. Oh, it's because of Apple. Because Apple blasted up, and we have so many long Apple positions. Holy crap. I mean, we're at 1960. So basically, we've gained over $200,000, almost $300,000. So from that, we've gained 15% in less than a month since this. So yeah, we lost money. The short-term portfolio, Control F STP. Because we made a lot of aggressive bullish changes in this last thing. That's what happened. So the short-term portfolio is 493. Now it's 511. That's gone up a little bit net because we already had those horrific losses. It's not like they changed. We had the big loss on TCA of 13,000. We lost 10,000 here. It's 25,000. But that big gain in Labor has offset a lot of it. And also this fast one went down. The loss on fast went down in the STP. See, it's about how all those things work together, not how any one thing is separate. Yeah, see, the fast also went from down 32 to down 19. So it's 13,000 gain there as well. So huge gain here and a huge gain here offset the losses over there, and we actually ended up with a little bit of a profit. In the long-term portfolio, we were at 1466. Oh, you know what? I did the math wrong over there. That's why we didn't gain that much. So I must have done the total wrong over there when I did it. What? That's not the long-term portfolio. Very obviously not the long-term portfolio. Here's the long-term portfolio. It was 1468. 1468. And now it's 157. So this is up 100,000 bucks. So it's not up as much as we thought. I'd done the math wrong in the previous thing, but we're up 100,000 here, and we're a little bit better than flat on the short-term portfolio. So the net gain is about $100 and something thousand since 20 days, which is good. It's about 5%. That makes more sense. So it's not about whether we're making, you can't look at SQQ and say, are we winning in SQQ? I don't want to win in SQQ. I want to lose money. It's like life insurance. I don't want to be dead tomorrow. I know I paid money for my life insurance, and I know I get a big batch of money if I win my life insurance game, but it means I'm dead. On the whole, I want to live. It's only in case of emergency I get some money. It's not money I want, and that's how you have to understand your hedges are. It's an insurance policy. It's not something you're trying to win. All right, got to answer these questions quickly and be done because I got to get out of here. $1 million question, hurricane direct hit on Miami. What does the market do? It's going to take a hit. The market's got to go. It's devastating Miami, as this thing is likely to do. As you're going to wake up on Monday and look at that's all it's going to be. It's going to be the aftermath of Miami. You're going to talk about taking a major city offline, Florida offline, $100 billion in cleanup costs, so on and so forth. It's going to be a downer, basically. There's no good way around that, and it's going to take months and months to recover and get everything back to normal. The airlines are going to take a massive hit. All sorts of bits in the economy. And you can talk about the benefits going forward of like rebuilding and the boost in the economy, but in the short term for the current quarter, it's bad. And then they've got the budget thing, and they'll be wrangling about that. There's all sorts of bad things coming after this weekend. So I don't think it's going to be positive for the market. Speaking of travel, are we doing anything in Vegas? That's good. I guess we got to start asking people. Nobody's organizing it. So I guess I'll have to see. I don't have time. I really don't have time to organize it myself. So unless somebody's going to step up, we're probably not going to do it this year. And maybe I'll do it in New York in the spring. But we'll see. I'll reach out to Phil, who organized it last year, and see if he's interested. But it's just not something I'm really prepared to do. Because I just don't have the time to physically have so many things going on right now that it's going to be slow. It's going to be difficult for me to add that to my list. XLF got hammered. I'm up 250 on my put. Momentum keeps thinking S&P should be much lower. CSIQ keeps going up. Should we be in it? We cashed out of CSIQ or AC again. Yeah, I'm thinking possibly doing one on the East Coast this year because I don't know. Unless somebody organizes Vegas, it's too much for me. It's like I can't go back and forth and deal with it. So a quick look at the things, and now I'm late. Let's see. Boom, boom, boom. Nothing exciting going on. We're kind of straggling along. And look, tomorrow, you got tomorrow, and then you've got probably the hurricane and the uncertainty. So I certainly would not be going long into the weekend. If I'm going to short something, I would short the NASDAQ 5964. That would be my short call. Now, NASDAQ companies are not really going to be negatively impacted by the hurricane because they're not in Florida. But I just think there's just general disruption, and like I said, they're just generally overvalued. So I just think on the whole, I'm very comfortable with where we are and the way we're hedged right now. I'm happy with that. Oil, like I said, I like oil, especially if it falls back below 49. You can use that as a line to short. I still have my 2 shorts anyway. I'm still long the dollar, and I think that's going to pop back up. And those are my favorite plays. Gasoline, I don't think it's too iffy. Natural gas. I'm looking at natural gas. I want to look at NGZ, which is at 320. Wow, that's a lot higher than the current contract. I do like it above that line, though. At 320, I like natural gas for long, but you want to just take a quick profit on that one. Like I said, the Nikkei, if the markets are going up, I'd go with the Nikkei, but on the whole, I'm not too interested in that one. So my number one here would be the NASDAQ short, 59.65, basically, there, and oil short at 49. Anything below 49, I like it short. And those are the trades I will leave you guys with, and we will do it again next week, all right? Thanks for coming, everybody. Oh, and don't forget to check out my BNN thing. I put it on the post because there's a bunch of trades on there we didn't get to. Forgot about that. Got this new portfolio for Money Talk. Money Talk portfolio. So the Apple trade, the IMAX trade, the LB trade, and the WPM. And we'll talk about that next week, and we'll see how it's going. Okay, but definitely check that out. That's on. It's all listed on the post from this morning. All right. So take care, everybody. Thanks for coming. How do we follow that portfolio? Well, that's it. I mean, as you know, nothing that ever happens isn't talked about in the chat room. So it's all going to come from chat when I make an adjustment. But this is a very low-touch portfolio because I only go on BNN maybe once a quarter. So basically every 3 months we'll go on TV and we'll talk about maybe adding a trade and adjusting the other trades. But I want to teach the people of Canada how to trade in a long-term portfolio and how to relax and trade and have the long-term perspective and sell the premium like we like to do. That's what I want. That's my goal on that portfolio. It's going to be very low touch. All right, take care, folks. Have a good day.